This short clip is from my live trading room. You can engage directly with my fabulous team and me at LaDucTrading.com for all our research and trades. Or for just my daily live streams, you can access via YouTube memberships. All links are in the description. I did update some key considerations, which is in this post that I did. The AI memory super cycle hits a pause, right? So we're not just talking about Iran escalation. The hits are definitely, they keep coming over in the Middle East. They are hitting ships, Qatar LNG, all kinds. Anyway, the point is that is escalating. Iran has now hit some refineries, and Trump is now saying he's going to send boots on the ground to Karg Island. It is basically a cluster. So we're going to just keep that in mind, that oil is a back-to-back backwardation. That means that the positive carry that helped short sellers are now going lower to negative. That's going against them. So we're going to see a squeeze. I have given 85 area where most of those shorts started to present. We dropped in crude down into that 67.90 gap fill area. We dropped in crude right back down perfectly into that gap up from the bombs away, right, on February 28th, end of March. It was on Friday night, Saturday weekend risk. And then we filled that, and now we're pushing higher. So we could absolutely see a squeeze on oil pricing into that 85. And that's what I put in my write-up as well. But I don't think we're going to get above that. I think that's going to be where they start to cover. And that's resistance now. That is resistance now. I gave you that like a few weeks ago. So here you go. This is the July 1st area where we came into that pre-Iran war gap fill. And here's where we had that memorandum of understanding signed that created the gap down below that 85 level. And so what's happened? Obviously, that's a good bounce area, and we're moving higher. Right now, we're in that 75, 65 area. And I can see absolutely a case to get back into 85. This is going to be a very, very likely area for a target long. And then, of course, yields are rising with oil because wars are inflationary. U.S. debt is increasing. Even precious metals could get a little bid. But the point is, this is where I think it will hit a lot of resistance. So you got your crude oil bounce in play. You've got a whole bunch of semi-rotation that worked perfectly. We came right on down with this is a semi versus software ratio. And here's that little channel that I had drawn. So we had a fake breakout, fast failure, and now we can digest here a little while. Wouldn't be surprised if we could even get moving a little bit more before we break down. But the point is, it's in play. Semi came back in, and now hyperscalers are trying to get a little bit of a support mechanism. I've mentioned this before, monetization. We're going to see if they actually can now that earnings are fast approaching. And this is what we're going to be looking for in earnings season. But it's interesting because you've got Apollo out this morning with a warning. So let me just share that with you real quick. And I just posted that this morning. So Apollo is out, and we got other big houses that are also warning, but a slower AI payoff would be everyone's problem. This is the title of Slock, the chief economist at Apollo. His title of his little rant this morning: consensus expects free cash flow for the hyperscalers to more than double over the coming years. And what if it doesn't happen that way? And also you have Chinese models that keep gaining, and they're cheaper, like 10% cheaper. Token prices keep falling. It's a really good argument for why cash flows and earnings could disappoint moving further into the future. Maybe they don't hit in this particular quarter coming up, but I wouldn't be surprised if investors who have already priced in as good as it gets in NVIDIA earnings, Micron earnings, and Samsung earnings aren't disappointed. So anyway, this is something I will add in later, but I had just written my post yesterday as it related to the AI ecosystem taking a pause. And that is literally what's happening. So the first area I want to talk about was oil. Second, yields rising with it before I think both get tapped back down. We've got a fabulous rotation that has happened in financials and insurers and industrials and airlines. But I think all of those that have jettisoned higher, XBI including, could be some rotation darlings. In other words, they have been the rotation darlings, could undergo some profit taking and digestion. Again, while that bottleneck versus hyperscaler debate rages on, I've written about this back in June 25th. AI buildout meets AI energy deflation when hyperscalers, that was basically the bottom in the hyperscaler trade, bottom, I should say. And then AI exhaustion into summer storm, especially if USD JPY does what it's threatening. That was the 29th. So we have seen the dollar rise up, and now we've got yields and oil rising up, and they're all equity headwinds. Basically, I gave some arguments as good as it gets. Meta triggered fears of excess capacity, chipflation at risk. So if we start to get unsold capacity sitting at GPU rental centers and rate hikes get priced out, big picture, you also have this evidence that DataTrek gave, which is super duper, that you have a potential for Mag 8 cheaper multiples in the second half. In other words, the top 5 semi names were absolutely driving the momentum higher, and they had 155% average year to date, just those 5 names, versus 1.6% for the Mag 8. Okay, clearly we can have a rotation out of semis that have a large valuation premium and back into the Mag 8. Anyway, these are the arguments that I was making before we started to top, which is a quarter advance in SOX of 100%, a 30% advance in the QQQs on a quarterly basis is just enough. So that's it. Memory supercycle takes a little pause. I can see some comparison also to how this looks like silver, right? Remember that January advance, and then we petered out for many, many months. I've made that case. And big picture, I know inflation expectations are rising right now because war is inflationary and oil moving higher with yields. But there's a big divergence, which is US one-year inflation swaps are the lowest since 2024. They have fallen very precipitously, which is basically pricing in this, I don't want to call it oil glut, but definitely the future pricing of oil is not concerning the inflation swap traders. They still see a bigger chance of Fed rate hikes getting priced out in the future. Now, right now, that's going to hold because we're back at war. But the point is, they're not really believing it. So just kind of keep that in mind. I think it's going to have, Fed's going to be hard pressed to hike more than one and done, given the fact that there's 10 trillion in short duration T-bills that have to be rolled this year. So that's it in a nutshell. Just wanted to remind you of the post that I put out yesterday, and then ironically, Apollo posted this morning about their concerns, and now you have both to weigh in your heads. You can see where crude is hitting its head very, very well at that thick line, which is 75.65, and you also know that the crack spread has been extremely profitable for refiners, and let me tell you, Klein Bryant is very bullish, the refiners, for a good long while. So this is not a trade that is bearish. If you recall, Valaro back here in April of 2025 was $100. Valaro is now approaching $300. This is the VanEck crack CRAK ETF, just that I have up here of all refiners. But I think it's really kind of telling that we've been in distribution, even though the war was in ceasefire mode. Crude didn't go anywhere but down. But the refiners, all they did was digest. They just digested beautifully, in fact. And now they're breaking out again, potentially. So anyway, that is still in play. Those refiners look fabulous, and we haven't even gotten into hurricane season.
Join Club to trade with Samantha. Scan this QR code or click the link in the description.